Welcome back to the deep dive. Today we're doing something a little bit different. We're putting on the suits, so to speak.
Metaphorically speaking, of
We're
course.
stepping into the boardroom.
That's right. It is Thursday, January 29th, 2026. And if you've glanced at your portfolio this morning, you might be needing a stiff drink.
Or maybe a celebratory cigar. It really depends on which side of the Tesla trade you're on.
It is completely polarized out there.
It is the morning after the Tesla Q4 2025 earnings call.
Yeah.
And honestly, the vibe is schizophrenic. You have headlines screaming first ever revenue drop.
And then you listen to the call and you hear Elon Musk talking about, what was it, amazing abundance and universal high income.
Right. And then you look at the stock chart itself and it looks like an EKG of someone having a full-blown panic attack. It's just all over the place.
It's a mess, a complete mess. But that's exactly why we're here today. We're not just going to read you the press release and we're not going to geek out on, the tech specs of a new battery. We are treating this next hour like an internal investment committee meeting. Think of us at a top-tier bank the morning after trying to make sense of it all.
I love that framing.
Yeah.
So, okay, I'll be the skeptical senior analyst. I'm worried about my year-end bonus. My clients are calling me.
And I'll be the, let's say, the visionary portfolio manager trying to see 2 or 3 years down the road. But we both have to be ruthless.
Absolutely.
Our mission today is simple. We have to sift through all the noise, the robots, the AI, the fabs, the talk about Mars, and strip it all down.
To the financials and the strategy.
Exactly. By the end of this deep dive, we need a verdict for you. Is Tesla right now today a buy, a sell, or a hold?
And the stakes feel unusually high this time. I mean, they always feel high with this company, but this time the story is fundamentally broken.
It really has.
For the first time in its history, the hypergrowth Tesla car story has hit a brick wall. Revenue is down. But at the same exact time, this AI robot story is just getting started.
It's like we're analyzing 2 completely different companies that are trapped inside one ticker symbol.
That's the perfect way to put it.
You've got the car company, which is, arguably shrinking, maybe even dying in its current form. And then you have the robot company being born. And the transition between those two.
That's the scary part.
That's what we in the industry call the valley of death. Tesla has to cross that valley in 2026, and it is not at all clear that they're going to make it to the other side unscathed.
Okay. Let's not get ahead of ourselves with the doom and gloom just yet. We have to start where every good analyst starts.
With numbers.
The cold, hard numbers. Section 1. The core financials. Let's separate the truth from the narrative.
All right. Let's open up the 10K and get our hands dirty.
I want to start with the ugliest number. The one that the bears are, tattooing on their foreheads this morning. Revenue. $94.8 billion for the full year 2025.
Which, in isolation, sounds like a tremendous amount of money. I mean, it is a massive company. But in the world of growth stocks, in the world of tech valuations, the direction of that arrow matters infinitely more than the size of the number itself.
And that arrow is pointing down. It's down 3% year over year.
For a company that was priced for perfection, I mean, you have to remember, this stock was priced as if it would grow 50% every year forever.
Until the heat death of the universe, right?
Exactly. So seeing a negative sign, any negative sign in front of the revenue growth number is a traumatic event for an investor. It breaks the psychological contract.
It does. But you have to peel the onion here, because that 3% drop in total revenue, it actually masks a much more severe problem.
That's right. The top line number is misleading. If you strip out the other parts of the business, energy, services, and you look strictly at automotive revenue, the picture gets much darker.
How dark are we talking?
We're talking a double-digit drop.
Yeah.
Depending on exactly how you account for their leasing business, auto revenue is down somewhere in the neighborhood of 10 to 11%. So they sold fewer cars, and they sold them for less money because of all the price cuts last year. In the world of traditional auto manufacturing, that combination is usually a death spiral.
Right, because of operating leverage. Can we just pause and unpack that term for a second? Because I think it's absolutely crucial for understanding why people are freaking out.
We should. Operating leverage is it's like gravity in manufacturing. It's inescapable. You have these massive fixed costs, the gigafactories, the robots on the line, thousands of salaried engineers.
They cost the same whether you build 1 car or 1,000,000 cars.
Exactly. Those costs don't change. So if your volume drops, if you're making fewer cars, Those fixed costs are spread over fewer units. Each car becomes more expensive to make, and your profits just get eaten alive.
So your profit usually falls much, much faster than your revenue.
Exponentially faster. So with auto revenue down 10%, Wall Street was expecting profits to fall off a cliff. We should have seen an absolute disaster on the bottom line.
We didn't. That's the confusing part. They actually beat earnings expectations.
They did.
The consensus on the street was for $1.45 earnings per share. Tesla delivered $1.50. So how is that mathematically possible? How do you beat profit estimates when your core business is shrinking that fast?
Well, this is the tale of two Teslas that you mentioned earlier. It's because while the car business was shrinking, the energy business decided to go supernova.
The megapacks.
The megapacks, the grid-scale storage, the utility side of the house, that division's revenue hit nearly $12.8 billion.
And what was the growth on that?
It was up almost 27% year over year. It's just a rocket ship.
So that's the clear MVP of the quarter, no question.
Without a doubt, if you were to chart it, you'd see the auto revenue line pointing down and the energy revenue line pointing almost vertically up. And here's the key insight that I think a lot of retail investors miss.
Okay.
Energy is becoming more profitable than cars.
Is it really? I always just assumed that cars were the margin king. That's where all the money was made.
That was the old story. Not anymore. Gross margins on the energy business are now pushing 30%.
30%, wow.
Yeah. The car business, even at its absolute peak during the supply chain shortages of 22, it barely touched that. Now, car margins are significantly lower, so the boring utility battery business is actually propping up the entire company.
It's a tugboat pushing a giant cruise ship that's run out of fuel.
That's a great analogy.
But is the tugboat big enough? I mean, $12.8 billion is fantastic growth, but the auto business is still the whale in the room. Can the energy division really carry the weight of a slumping, much larger car business?
In terms of replacing the revenue dollar for dollar, no, not yet. It's bridging the gap, but it's not fully replacing it. But, and this is important, in terms of profit contribution, in terms of the actual cash flow that keeps the lights on and funds all this R&D.
It's doing a lot of the heavy lifting.
A huge amount. It's buying them time. It's giving them the runway to execute this massive pivot we're about to talk about.
Okay, so energy saved the quarter. That's takeaway number one. But let's go back to that earnings beat, that $1.50 per share. Besides the boom in the energy division, how else did they manage to squeeze out that extra profit?
Efficiency. This is where the bulls have a legitimate point, and you have to give them credit. If you look at the cost of goods sold, or AGS.
The cost to build each car.
Right. They drove the average cost per vehicle down again.
Oh.
This is the story of gigacasting, process innovation. They are just relentless at squeezing every last penny out of the supply chain and the factory floor.
But there's always a gotcha with Tesla earnings beats. There's always an asterisk. And we have to talk about the regulatory credits.
We do. It's the perennial asterisk, isn't it?
Yeah.
In Q4 alone, they booked $542 million in regulatory credits.
Let's just be clear what that is. That's $500 million of pure 100% margin profit.
Yeah.
It's not from building anything. It's just from selling pollution credits to other automakers.
Essentially, yeah. It's Ford or GM or Stellantis paying Tesla a fee because they couldn't meet their own emissions targets with their gasoline cars.
It's free money.
It is free money. And if you take that $542 million away, that earnings beat completely evaporates. It gets much, much tighter.
So the beat was an illusion.
I wouldn't go that far because, and I want to be fair to the bulls here, even if you strip those credits out, there is a silver lining buried deep in the numbers.
Okay.
If you look at automotive gross margin, excluding those credits, it actually went up from Q3 to Q4.
Wait, really? How is that possible with volume down and prices down?
It went from 15.4% in Q3 to 17.9% in Q4. It's a significant sequential improvement.
What does that tell you?
It tells me that the price cuts have finally stabilized, and the cost cuts, that relentless efficiency grinding you see in the factories, is actually working. It's outpacing the price headwinds.
So they're running a tighter ship.
A much tighter ship, even if that ship is carrying less cargo right now.
That's a critical nuance. Because usually when a factory slows down, efficiency tanks.
Yeah.
The fact that they improved it is, well, it's impressive. It shows real operational discipline.
It does. But let's be honest, nobody on that earnings call really wanted to talk about growth margins on a Model Y.
No, the analysts were chomping at the bit to talk about the pivot.
Yeah.
The big vibe shift.
The hardware to AI pivot. This moves us right into section 2, the strategic risks. Because this isn't just about selling fewer cars anymore. It's about actively choosing to stop selling some of their most iconic cars.
The end of an era.
Truly.
Elon dropped the bomb pretty casually, but it was a bomb nonetheless. Production of the Model S and the Model X will wind down and basically stop in Q1 2026.
Which is right now.
It's happening as we speak.
It's immediate. And frankly, it's shocking to hear it said out loud, even though we've seen the sales numbers dwindling for years.
I mean, these are the flagships. The Model S is the car that started the entire EV revolution. It proved an electric car could be beautiful, fast, and desirable.
The Plaid is still the fastest accelerating sedan on the planet.
And the Model X with the Falcon wing doors, I mean, come on, that's an icon.
Yeah.
And they're just killing them.
They are executing them publicly. And you have to understand the symbolism, but more importantly, you have to understand the hard economics behind the decision.
Okay, walk me through it.
These are low-volume, high-complexity cars to build. They sell, what, maybe 50,000 or 60,000 a year combined now.
In the grand scheme of Tesla's 2 million unit a year operation, that's a rounding error.
It's a distraction, but it's a profitable distraction.
That's my point. It's a revenue hole. Those are $100,000 plus cars. You kill 50,000 of those, you are wiping out billions in high-margin revenue instantly.
It creates a massive revenue hole, absolutely. There's no debating that. But you have to look at why they are doing it. Elon was very, very specific about this on the call, and this is where the strategy gets incredibly aggressive.
Okay.
They aren't just shutting the S and X lines down to save money or to turn off the lights in that part of the factory. They are physically gutting that floor space in Fremont.
And what are they putting there instead?
They're installing production lines for Optimus.
The robot, the humanoid robot.
That's the plan. The stated goal is to produce 1 million Optimus robots per year from that specific factory floor space where the Model S and X used to be built.
Let's just pause on that number for a second. 1 million. A million humanoid robots a year.
Yeah.
We haven't even seen one mass-produced robot from anyone, ever. We've seen some very impressive prototypes folding laundry very, very slowly. And he's talking about 1 million a year from one building.
That is the pivot. You have to understand, it's a trade-off. You are trading a known, profitable, but declining asset luxury electric sedans for a completely speculative but potentially infinite asset humanoid labor.
It's the ultimate burn the ships moment for the company. There's no going back from this.
None. And it is not cheap to burn those ships. This brings us directly to the Capex explosion.
Right. The guidance for capital expenditures in 2026. They guided for over $20 billion.
That number is just staggering. I had to read it twice.
For context, what were they spending before?
In 2024 and 2025, they were hovering around the $10 billion mark, which is already a lot. To jump to $20 billion in a single year, during a year where your revenue is actually falling.
That is beyond aggressive. That is bet the company money.
It absolutely is.
So where is it all going? I mean, for $20 billion, you can buy a small country, or at least a mid-sized legacy automaker.
Vaibhav Taneja, the CFO, he broke it down, and it's basically a shopping list for building the future of the company. It's a massive investment.
Okay, what's on the list?
First, you have 6 new major production lines. You've got the LFP battery factory. That's the lithium iron phosphate, the cheaper, more durable batteries. You've got the new Cybercab production lines.
The Robotaxi?
Right. You've got the Seme factory ramping up in Nevada and the new Megapack factory they're building in Shanghai.
Okay, so a lot of that is still traditional manufacturing stuff. Factories, batteries, trucks.
It is. But that's not where the really big money is going. The true black hole sucking up the cash, it's all going into AI. It's going into compute.
Cortex-2.
Exactly. They are building out their next generation supercomputer, Cortex-2, in Texas. They are buying tens of thousands of H100 equivalents, whether that's from NVIDIA or their own Dojo and AI5 chips.
So this is an infrastructure build-out for a company that isn't really an automaker anymore.
That's the point. They are building the infrastructure for a compute company. They are building a massive centralized digital brain.
So they're bleeding cash from the car business to build and feed this new brain.
Precisely. And speaking of feeding the brain, or perhaps feeding the CEO's other interests, we have to touch on the XAI deal.
Oh, yeah. This was the most controversial part of the call for me.
For a lot of people.
So Tesla is investing $2 billion of its cash into XAI, which is Elon's separate private AI company.
Correct.
I have to play devil's advocate here. Elon runs Tesla. Elon runs XAI. Elon is taking $2 billion of Tesla shareholder money, my money, your money if you own the stock, And is moving it to his other company, XAI.
Mm-hmm.
Isn't that just moving money from his left pocket to his right pocket? Why not buy back Tesla's stock if you have $2 billion just lying around and you think the stock is undervalued?
Mm-hmm. It's a massive governance red flag. In any normal company, the board of directors might block that transaction as a clear conflict of interest. And the analysts on the call, to their credit, they tried to poke at it. They asked, why do we need this? What is Tesla getting for its $2 billion?
And what was the defense? What was the justification?
They offer what I'm now calling the orchestra conductor theory.
Okay, I'm intrigued. Enlighten me.
So Elon's argument goes like this. Tesla's AI is very good at real-world AI. It's good at vision, navigation, moving the arms and legs of a robot, not bumping into walls.
The physical world stuff.
Right. But xAI's model, Grok, is a large language model. It's a reasoning engine. It understands context, language, and high-level strategy.
So the Tesla brain sees the road and drives the car. But the XAI brain tells the entire fleet where to go to be most efficient.
That's the pitch, precisely. If you have 10 million robotaxis on the road and 1 million Optimus robots working in a factory, you need a high-level intelligence to organize them all.
To orchestrate the swarm.
Right. To say, okay, robot A, you go to the loading dock. Car B, you go pick up the passenger at the airport because there's surge pricing. Elon claims Grok is that orchestra conductor. So the $2 billion investment is pitched as buying the license to use that high-level intelligence to manage the fleet.
Whether investors buy that logic or just see it as an Elon tax. Well, I guess that remains to be seen. But, okay, let's look at the timeline. Because all of this spending, all of this pivoting, it has to lead somewhere. Section 3, future value and the path to amazing abundance.
The timeline is absolutely critical here because, as you've said, 2026 is going to be a very, very bumpy ride. Investors need to know when the pain is supposed to stop.
So let's break it down chronologically. Let's start with the next 6 months, the first half of 2026. What are the key milestones we should be looking for?
Execution. Pure and simple. The single biggest piece of news from the call was about FSD in Austin. They are now running paid rides with no safety monitors in the car and no chase cars following them.
That is a huge milestone. For years, it's been testing, testing, testing. Always with a human sitting in the driver's seat, ready to grab the wheel at a moment's notice.
Always with a safety net.
Now it's deployment. This is the real deal.
It is. Now, it's still geofenced. It's limited to Austin and parts of the Bay Area for now. But taking the human out of the loop entirely, even in a limited area, is the proof of concept. If they can scale that without a major accident, the entire bull thesis holds. That is the singularity moment for the stock.
And what about the hardware? Cybercab production is supposed to start in April.
That's the target, April 2026. But it's really important to remember the S-curve of manufacturing. Production starts slow.
We should not expect tens of thousands of Cybercabs rolling off the line in Q2.
No. You should expect a handful, maybe a few dozen, then a few hundred. The real exponential ramp comes later. And that leads us to the next phase on the timeline.
The Valley of Death. The second half of 2026. This is the part of the story where I get really worried as an analyst.
This is the danger zone for the stock. Just think about the math here. You have $20 billion in cash going out the door for Capex.
You have the revenue from Model S and X disappearing completely.
You have Model 3 and Y sales slowing down because the models are getting old and the competition is fierce.
And the new stuff, the Cybercab and Optimus, they won't be generating any meaningful revenue yet.
It is the perfect storm for terrible-looking financials, high expenses, falling revenue. The income statement is going to look ugly.
And there's another factor, right? They're shifting FSD entirely to a subscription model.
That's a huge point. They mentioned they're sunsetting the big upfront payment option.
So instead of getting, say, $8,000 or $12,000 in cash upfront when someone buys the FSD package with their car,
they get $99 a month or $199 a month. In the long run, that is a much better business model. It's high margin, recurring revenue. It's the Adobe model, the Microsoft model.
But in the short run?
In the short run, it creates a revenue crater. You lose that big lump sum of cash and you replace it with a tiny little trickle. So that's another headwind for margins in late 2026.
So 2026 is, without a doubt, the year of pain. It's all spend, very little new income. But then, the promise is 2027.
Yeah.
The AI payoff.
That's the vision. That's when you're supposed to reach the promised land of amazing abundance.
Elon talked about universal high income. He was very specific, not universal basic income, high income.
And this is where we have to step out of traditional financial analysis and get into, like, sci-fi economics.
Go for it.
The theory is this. If you can successfully deploy millions of autonomous Optimus robots, the cost of labor drops to near zero.
Okay.
And if the cost of labor is near zero, the cost of all goods and services plummets. GDP, gross domestic product, is basically just the number of people in an economy times their productivity. If robots make productivity effectively infinite, GDP becomes effectively infinite.
And everyone gets rich. I mean, it sounds a little too good to be true.
That's the pitch. And specifically for Tesla as a business, the model shifts completely. They aren't selling robots like they sell cars, where you buy it, it's yours, you park it in your garage.
Right.
They are selling labor as a service.
Like that Airbnb model for the Robotaxi he's always talking about.
Exactly. The idea is you, as an individual, might buy a Tesla robot or a cybercab. You add it to the Tesla fleet, and Tesla rents out its labor. So you're not buying a machine, you are buying an economic agent. You're buying an employee that works 24/7 and sends you the paycheck.
It's a fascinating, world-changing concept, if it works.
A very big if.
It relies on 1,000 things going perfectly right.
Okay.
Which brings us to our next section, Section 4, the hidden risks.
Mm-hmm.
Because there are some serious red flags in the Q&A of this call that we need to shine a very, very bright light on.
The biggest one for me wasn't even about cars or robots. It was about paranoia, or, depending on your point of view, extreme foresight.
You're talking about the terafab.
The terafab, yes. This is something that I think a lot of the headlines completely missed because it's so technical. But Elon spent a significant amount of time on the call talking about geopolitical risk.
I noticed that.
He believes that within 3 to 4 years, the global supply of high-end AI chips, the logic, the memory will run out. Or, even worse, it will be cut off by a war or a blockade.
He specifically mentioned that there are 0 advanced memory fabs in the United States. 0.
He painted this very stark picture where the Pacific Ocean becomes a no-go zone, and suddenly Google, Microsoft, Meta, Amazon, Apple, every major tech company is starved of compute. Their AI ambitions grind to a halt.
And his solution to this potential crisis is the terafab. Tesla is going to build its own, from-scratch, leading-edge semiconductor fabrication plant in the United States.
Now, look, I'm not a chip engineer, but I follow the semiconductor industry very closely. Do you have any idea how hard it is to build a fab?
I know that a company like TSMC spends tens of billions of dollars a year just to keep the lights on and stay on the cutting edge.
It is arguably the single hardest manufacturing challenge on planet Earth. It involves moving individual atoms with light. It involves clean rooms that are thousands of times cleaner than a hospital operating theater. You can't just, decide to do that one day. It takes decades of institutional knowledge.
And Elon even admitted it on the call. I wrote the quote down. He said, "I know fabs are really hard, but we do hard things."
That phrase just keeps ringing in my ears. We do hard things. Is this extreme confidence born of past success, or is this hubris? Is this Icarus flying way too close to the sun?
Because from my perspective as a financial analyst, it sounds like a capital incinerator. They are budgeting billions and billions for this project. If they fail, and statistically most new fab projects fail to yield good chips for years, that money is just gone.
Poof. It's the ultimate hedge. It's a binary bet. Look, if he's wrong and the world stays peaceful and supply chains remain open, it's a colossal waste of maybe $10 billion. A very painful write-off.
But if he's right.
If he's right. If China blockades Taiwan in 2027 and every other AI company in America is starved of compute, Tesla becomes the only game in town. They would literally own the physical infrastructure of intelligence in the Western world.
So it's insurance. It's just very, very expensive insurance against World War III.
It's existential insurance for the company's AI ambitions. He's betting that the global supply chain is fundamentally fragile, and he refuses to let Tesla's destiny rest in the hands of a single shipping lane in the South China Sea.
Okay, that's a huge long-term risk. What about the risks that are staring us right in the face today? The demand void. We talked about sales dropping. Did management have a clear answer on how they're going to stop the bleeding, particularly in China?
No, not really. To be blunt, they dodged the question. Multiple analysts asked about BYD, they asked about the competition, and they asked about the Model 2, that rumored $25,000 human-driven car that we've been hearing about for years.
And the answer was?
The answer was always Cybercab. Every single time they were asked about a cheaper car to boost volume, Lars Moravi, or Elon, would pivot the conversation back to the Cybercab and the Robotaxi network.
So is the Model 2 dead?
It seems deprioritized to the point of death. They're making a fundamental bet that a cheap Robotaxi is a better product than a cheap car you drive yourself. But that leaves a massive gap in the product lineup.
A huge gap.
If you're a customer in China or Europe and you just want a cheap, reliable EV to drive to work in today, in 2026, Tesla doesn't have a new product for you. You have to wait for the robot. And that gives BYD and others a wide open lane to just hoover up market share for the next year or two.
That is a very risky gap to leave open. If you lose those customers now, it is incredibly hard to win them back later.
It is.
Okay, and final risk. Let's talk about FSD adoption. The take rates. They cited a big number.
Yeah.
1.1 million paid FSD users.
Which sounds impressive. It's a big number. But when you dig into the details they provided, you find that something like 70% of those were upfront purchases, people who bought the package over the last 5 or 6 years.
So that's legacy users. What about new growth, the subscription growth? Is it stalling out?
It looks like they're hitting a saturation problem. They have penetrated the early adopters, the techies, the diehard fans who were willing to pay for the promise. Now they need to convince the average driver, your mom, your neighbor, to pay $100 or $200 a month for this service.
And if that take rate, the percentage of new buyers who choose to subscribe, if that doesn't spike up dramatically now that they have these new unsupervised features,
then the whole software margin story collapses. The entire thesis that Tesla should be valued like a software company, not a car company, it just falls apart.
Okay, wow. We have covered a lot of ground. We've done the numbers. We've analyzed the pivot to robots. We've looked at the timeline of pain and the existential risks of the terafab. It is time.
The verdict.
The investment memo verdict. We are the committee. We need a rating. Buy, sell, or hold.
This is genuinely the hardest rating I've had to come up with on a company in a very long time.
Don't wimp out on me now. Let's start with the bull case. Be an advocate. Why do you BUY this stock today after all of this?
You buy it because the pivot is real. The unsupervised FSD, now running in Austin, proves the core technology works. It is not vaporware anymore.
Okay.
You buy it because the energy storage division is a massive, highly profitable growth engine that is printing cash and buying them the time they need to get through 2026. And fundamentally, you buy it because if, and it's a big if, but if Cybercap and Optimus work, the total addressable market isn't the auto industry anymore. It's the entire global economy. It's labor itself. It's amazing abundance.
Okay. Strong case. Now be the bear. Rip it apart. Why do you sell this stock immediately?
You sell because the core business, the thing that actually makes money today, is shrinking. They are losing market share in the hyper-competitive EV space. You sell because they are burning $20 billion in cash on unproven sci-fi markets while actively killing their reliable high-margin revenue generators like the Model S and X.
The governance risk.
You sell because of the governance risks with the XAI deal and the sheer, almost impossible manufacturing difficulty of building a terafab while also trying to solve general-purpose robotics. You sell because you think the distraction will kill the company before the dream can be realized.
No, the bull case is infinite upside. The bear case is bankruptcy. Where do you land? What is the verdict?
My verdict as of January 29th, 2026 is a high-risk buy, or if you have a lower tolerance for volatility, a volatile hold.
Unpack that. High-risk buy. What does that mean for an investor?
It means you absolutely cannot value this as a car company anymore. If you want safe, predictable returns from selling cars, go buy Toyota or GM, or frankly, just buy a bond. If you hold or buy Tesla stock today, you are buying a Robotics and AI ETF. You are buying a venture capital ticket to the future. That's what it is.
You're buying a lottery ticket on the age of abundance.
Exactly. And if you believe that age of abundance is only 24 to 36 months away, then the stock at these levels is probably cheap. But, and this is a huge but, you have to be willing to endure the pain of 2026.
It's going to be an ugly year.
2026 is going to be brutal. The financials will look bad on paper, the capital spend will be terrifyingly high, the top-line growth will likely be negative again. You are holding on purely for the tech narrative to pull you through to 2027 and beyond.
So the message is, buckle up. It's going to be an extremely bumpy ride.
The bumpiest, but the potential payoff, if they pull it off, is unlike anything else available in the public markets.
Well, that brings us to the end of our deep dive.
Yeah.
A very clear, if very volatile conclusion. And I want to leave you, our listeners, with one final thought to mull over. Elon's new mission statement, his new mantra is amazing abundance. It sounds great. But if Tesla actually pulls this off, if robots really do create universal high income, and the cost of all labor and goods falls to near zero, does the stock price even matter anymore?
That's the real meta question, isn't it? If money itself becomes abundant, the very value of money changes. We might be sitting here analyzing the stock price of a company that is actively trying to make the stock market itself obsolete.
A provocative thought to end on. Remember, this deep dive was based strictly on our analysis of the Q4 2025 earnings update. As always, do your own research, watch those margins, and we'll see you next time on the deep dive.
See you then.